Hey guys, my name is Dan and welcome to my channel. I hope you guys are doing well. And don't forget to hit that subscribe button if you've enjoyed my videos so far. Thanks for your support. For those people watching for the first time, do check out my other videos as well. You'll realize that I don't really talk about which stocks you should be buying or selling because I think that's a really personal thing. Just because I'm invested in one stock doesn't mean you have to be invested in the same stock too. Instead of that, I'd rather share with you how to go about doing certain things, understand why and how things happen. So if you're looking for a buy or sell recommendation on the stock, then unfortunately you've come to the wrong place. Anyhow, in this video we're going to be exploring how you can be more prepared as an investor in the stock market. If you've been in the stock market long enough, you'll realize that some of those events can trigger our reactions in the wrong way. And in those situations, not only have you lost to the market, but you've lost to yourself. The hardest thing that you'll face in your life is probably yourself too. And Ben Graham once said that the investor's chief problem and worst enemy is likely to be himself. Under normal circumstances, no one is forced to invest in something that they have no say in. Whether you've invested in managed funds or certain individual stocks, these are all your own choices. You picked a stock over the other one because your gut feeling told you or someone else told you. You can't control what other people tell you, but you can at least try and control your own emotions and reactions to certain things. Sometimes we behave illogically because we've simply lost ourselves or have forgotten what our objectives are. So the first thing I want to talk about is ask yourself again, what is the purpose and what are your objectives? It is easy to forget our beginnings because we're all busy people. And sometimes we're so occupied with the present that we forget to think about the past and the future. Why did we start investing? What are our financial objectives that we're trying to meet? Having a purpose is so important because that is what really drives the way you see the stock market and how you behave. For example, before you started investing, you set a goal for yourself to reach, say, 10k in 5 years with an initial investment of 5k. You studied the ways of the great investors, read many books on them, and you think you understand what their theories mean. You think to yourself, finally I'm ready. You finally get into the stock market, you're so excited, you look at the prices every day, and after the first week, you see your investment appreciating by 5%. You think to yourself, wow, this is an easy game, so you add more money, not knowing the stock market goes 5% the other way the following week. You're now worried that the stock market will keep going down, so now you sell some at a loss. The market repeats again, and you do the same thing. And now it seems like you're speculating rather than investing. So why did I use that example? Because that was exactly one of the mistakes that I made when I just started investing. I had forgotten the basics, the whys and hows. It is important to slow down sometimes and not get ahead of yourself. To constantly remind yourself of why you're doing what you're doing. Because once you lose yourself, you get into the vicious cycle of repeating those mistakes until the loss is too great to recover. The second tip is that you have to understand that nothing is guaranteed in the stock market, and there is no such thing as a free lunch. For every stock you invest in, it'll come with some level of risk. Even trillion-dollar companies like Apple and Microsoft have risks. Do not think that they're immune to bankruptcy. It's just that the chances of that happening are very low. But sometimes these corporations are just too big to fail. Because of the size and impact to the economy they'd bring if they did go bankrupt, the government would intervene and bail them out. And this was the case with General Motors in 2009. Fast forward 10 years, and who would have thought that airline companies would end up on the verge of bankruptcy? And how many people thought airlines would have little to no risk before this virus happened? If you look at the 10K SEC filings, or the annual reports of airline companies in the US, you'll find that there is a section where it talks about the risk factors relating to the airline industry. At the very end of that section, it does talk about the risks posed to the airlines if a contagious illness were to happen. But how many people read that nowadays, right? But just be aware that not all annual reports will disclose every risk factor, especially the annual reports that are non-US. So remember, before you invest, always research and think about the risks and the probability of those risks happening to the companies you're investing in. My third tip is to always be humble and just keep on learning. Just because you're up 10% year to date and the broader market is down 10% doesn't mean you should brag about it or be complacent, because you've got to understand the market can do anything. So study why certain stocks are up, and study why others are down, because when you do that, you'll develop your own perspective and you'll be able to justify your actions in certain situations. Being in the stock market is one of the best ways to learn about yourself. It's really an arena that pushes and tests your boundaries, handing you challenges from all kinds of directions. It's a test of discipline, self-control, and how well you know yourself. And there are no two situations that are the same. Be humble, not arrogant, but be confident. Bill Ackman, one of the most famous hedge fund managers, once said that if you're not confident, you'll never make an investment. And part of building your confidence is through learning. Learn from the great investors, from the books they've written or through their interviews on YouTube. Learn their mistakes under different situations, because you'll no doubt encounter your version of that situation. The fourth one is don't just follow the crowd or invest simply because you fear you might miss out on gains. This is known as FOMO, and this is an example of cognitive bias, as our decisions are affected by perceptions that may not be totally accurate. It's the mentality that, oh, since everyone's doing this, it must be right. But then it's not to say that you should always go against the crowd. You can't rule out the fact that sometimes the crowd can be right to an extent, but the difference is that the crowd's sentiment is based on perceptions and seldomly based on the fundamentals of the business. The crowd may know when to get on the bandwagon, but the question is, do they know when to get off? The type of investors that go against the prevailing market sentiment are known as contrarian investors, but do they always have to go in the opposite direction to the market? Peter Lynch said in his famous book, One Up on Wall Street, that the true contrarian is not the investor who takes the opposite side of a popular hot issue, i.e. shorting a stock that everyone else is buying. The true contrarian waits for things to cool down and buys stocks that nobody cares about. We simply need to be more cautious around the times and the stocks when we see that sentiment doesn't really match the fundamentals. I'm not telling you to pull out from the stock market completely as soon as you feel that way, but that would be a time to review your risk profile and how that's been reflected in your portfolio. And this FOMO sentiment brings me to my last point. Last but not least, it is important to read the numbers more than the words. And what do I mean by that? Would you rather believe in the 10Ks annual reports or believe what your friends say is about a stock going up? And it's not surprising that most people will probably choose to do the latter. And it is human nature to find information that supports the existing beliefs and reject information that is on the contrary. Say you own some Apple stocks and you're thinking that the stock price is a little high compared to historical averages. Then, on the back of an average earnings release, you start seeing these articles about how Apple stock is too expensive, overvalued, they're losing their innovation edge, their products are overpriced, etc. So you have these experts commenting on why people should avoid Apple. You see these articles and they instantly reconfirm what you initially believed. You did find a few articles that were on the contrary, but because there were only a few and did not align with your beliefs, so you ignored them. This type of situation is known as confirmation bias. You place more weight on information that confirms your beliefs. In other words, you believe what you want to believe. This is dangerous because you end up filtering out information that could be important. And rather than investing based on all fundamentals of the company, you may end up trading based on people's opinions. So how do you find the right mindset? It's definitely not a simple task because you almost have to adjust your behavior to different kinds of situations. And the truth is that everyone makes mistakes, even the great investors. But you have to accept the fact that not every trade or action that you make will be perfect, but for every action that you do take, you need to be able to justify why you did it. Thanks for watching, guys, and I hope those tips are able to help you in one way or another. Make sure you subscribe to the channel to see more of these videos. Thanks for your support and see you next time.